And now, here's David Hayes.
Welcome to 2025, the final drive, what you need to know to win. I apologize for the long hiatus as I took a little bit of a break from recording these podcasts. After my mom's passing in February, I was just back on my heels a little bit. So I continued to do the radio show as an obligation because the show must go on. But as a podcaster, you can pick and choose when you put out content. So we are going to continue to put content out. I promise you that. We're going to have some opportunities to interview outstanding minds as well when it comes to how to avoid getting killed by taxes, not just now, but in the future. So lots of things to talk about, and I've got a good one today. Are tax-free bonds really tax-free? Oh, goodness gracious. The answer is sometimes. Well, let's first talk about who should even consider a tax-free bond, or what is a tax-free bond. So let's talk about what is a tax-free bond first. Tax-free bonds are generally issued by municipalities or states. The interest that you earn on those bonds are federally tax exempt, and if you bought a bond in the state you live, it's usually tax exempt at the state level as well. However, if you own a tax exempt bond in, let's say, California, and you live here in the great state of Indiana, federally, it would be tax exempt, but it would not be exempt from state tax. So the first thing you have to consider is, what is the tax equivalent yield? Most of the time, folks in the lower tax brackets, the 20, 22, probably don't need to be messing around with tax exempt bonds. But once you get to the 37% tax bracket, and soon to be 39.6 after the tax code expires at the end of 2025, yeah, it might make sense to consider tax-exempt bonds. Now, these are not in retirement accounts, right? These are accounts that are held outside of retirement accounts, things that are taxable or tax-free as you go. So here is how easy it is to determine a tax equivalent yield. Take 1 minus your tax rate. So if you're at 37%, that's 0.63. 1 minus 0.37 equals 0.63. Then divide that into the tax-free yield. So let's say you can buy 3% tax-free. I divide that by 0.63. That equals 4.76. So if I earn 4.76 taxable, that's the same as me earning 3% tax-free. Now, that's not all the story, because the next part of that is, what about state? That's only if you bought a bond in the state that you lived. So let's add in state tax. Now we're at 42%. So 1 minus 0.42 equals 0.58. Now the tax equivalent yield is 5.12. We would need to earn 5.12% taxable to equate to a 3% tax-free bond. So that's how you do the math, and that's how you determine if it makes sense for you and your family to own tax-free bonds. The other thing about tax-exempt bonds is they rarely default. Corporate bonds default. Other forms of bonds, they do default. But municipal bonds, whether taxable or tax-free, and there are taxable munis as well, the default rate is basically zero. So you have a lot of safety, a lot of security, and in many cases, tax-free, both federal and state. Now, I'm talking about buying a bond at par value. I buy a $10,000 bond, it costs me $10,000. Now, you can buy a bond at a premium or a discount. The only time you would buy it at a premium is if the interest rate was really high. You may have to pay up for that. If the interest rate is lower than the market, then you would buy it at a discount. And I'll come back to that in just a few minutes. But here's the interesting thing about income and, let's say, taxes on Social Security. Remember, it was 1983 when taxes first became a thing on Social Security. And then in the 90s, we went and added the new threshold of 85%. So up to 50% of your benefits taxable once you hit a certain income level, and then up to 85% once you hit another income level. And it motivates me to show up and do these podcasts. So God bless you. God bless America. And if you'd like to talk about how we can help you navigate these complicated issues, please go to cfci.us and contact us to set up your complimentary call, or do it the old-fashioned way. Call us, 812-334-3190, and I promise we'll make it happen. Just simply say, hey, I was listening to David's podcast. I would like to set up my free 20-minute call with one of our advisors. No obligation, guys. I'm telling you, we want to be the sounding board of America, so people can call us, they can email us, and we can help them do the right thing, period. Have a great one, everyone. Bye-bye.
Thank you for listening to this podcast. The clock is ticking. Each decision that is made today will put more money into your pocket or leave you worried about your financial future. The time to prepare is now. The time to eliminate risk was yesterday. Let's partner to help those around us to make decisions that empower their financial future. If you would like to book David for a speaking event, please contact CFC at cfci.us. You can purchase his book, 2025 The Final Drive, by going to www.cfci.us and clicking on 2025 The Final Drive. Offered through J.W. Cole Financial, member FINRA and SIPC. Investment advice offered through CFCI and J.W. Cole Advisors. J.W. Cole Financial, J.W. Cole Advisors, and CFCI are unaffiliated entities. The opinions expressed by David Hayes and his guests should not be construed as specific investment, legal, or tax advice. All economic and performance information is historical and is not indicative of future results. Investing may involve the risk of losing principal. Any tax advice on this show is not intended to be used by any person for the purpose of avoiding U.S. federal or state tax. Penalties may be imposed on such a person, and each listener should seek advice from their tax advisor or legal counsel on topics that arise from the show. David Hayes and his guests are not providing legal or tax advice. Nothing should be construed as solicitation or an offer to buy securities.